Remember 2008, the crash that wiped trillions? Well, we may be teeing up the sequel, and this time your savings and your mortgage could be the co-stars. Today we'll look at Rachel Reeves' new Leeds Reforms and discuss whether they could blow a huge crater in your personal finances. Hi, I'm Alpha, Chartered Financial Advisor, and in this video we're going to be discussing the government's new financial services growth strategy and find out if this really is the renewal of Britain or the start of another cycle of the unsustainable debt and unsuitable investments that could reshape household personal finances for a generation. So last week, the Chancellor Rachel Reeves introduced the Leeds Reforms, a package of measures aimed at boosting the UK's financial services sector and by extension, wider economic growth. The plan includes faster regulatory approvals for banks and insurers, streamlined senior manager rules, relaxed mortgage lending limits backed by permanent government guarantee schemes, and steps to encourage retail investors, such as making long-term asset funds eligible for stocks and shares ISAs from April 2026. Together, these changes are pitched as a way to channel more capital into businesses, widen access to home ownership, and position Britain as the world's leading hub for financial innovation by 2035. So what's changing? Well, a lot of things, but here are some of the highlights. From April 2026, long-term asset funds, think private equity style funds, become eligible for ISAs. Banks can proactively contact customers with targeted support, so guidance intended to flag investment options to savers who hold large cash balances. Higher loan to income headroom. The Bank of England is relaxing the 4.5 times income cap, letting lenders stretch debt multiples for more applicants, particularly first-time buyers. A permanent mortgage guarantee scheme. The government will continue to back 95% loan-to-value loans, giving lenders confidence to offer low deposit products even in downturns. Simplified affordability tests. The FCA is consulting on streamlining stress testing, making it easier to qualify if rates rise modestly rather than under a worst-case scenario. A ring-fencing review. The Treasury will examine loosening the 2019 rules that separate retail banking from investment arms, exploring whether banks can share resources or offer more services inside the ring fence. Faster authorisations. The FCA deadlines drop from 6 months to 4 months for new firms and from 3 to 2 months for senior manager approvals. Senior manager and certification regime overhaul. Targeted 50% reduction in roles needing pre-approval and lighter ongoing certification requirements. FCA review of existing risk wording. The regulator has opened a consultation on whether current capital at risk and value can fall banners are too generic, aiming to replace them with shorter, clearer and product-specific messages. I mean, I'm not sure how much shorter than capital at risk you can get, but okay. And although not yet announced, the Treasury has hinted at bigger ISA overhauls later this year, potentially limiting the amount of ISA savings that can be held in cash. From the numbers that have been thrown around, this could be £4,000 or £5,000. Now here's why I'm worried. Banks are being let off the leash and risk warnings are being watered down. It's like teaching people to drive, handing them the keys on the M25 and just saying, keep left. Remember, market's always correct. The dot-com bubble in 2000, credit crunch of 2008, COVID crash in 2020. Every time inexperienced or first-time investors panic sell at the bottom. After the 2008 crash, the FCA tightened sales suitability rules and increased the standards of professional qualifications required for those giving advice. It feels like if we water down or remove some of those safeguards, we're queuing for the sequel. Same plot, new victims. On paper, trimming bureaucracy sounds efficient. Who doesn't want a nimbler regulator? As someone who's been through the FCA authorisation process, trust me, I do. But the worry is that speed comes at the cost of scrutiny. Authorising a brand new lender isn't like approving a planning application. It's green-lighting the people who will be looking after billions of pounds of other people's money. Shave a third off the timetable and you risk rubber stamping business models or individuals before anyone's kicked the tyres properly. We learned in 2008 that a single rogue desk or a poorly designed product can snowball into a systemic mess. Why reintroduce the risk just so a handful of applicants can get to the market a few weeks sooner? The senior managers and certification regime was the post-crash antidote to the old no one's to blame culture. By putting named executives on the hook, it forced banks to think twice before chasing quick wins that could blow up later. Halving the number of accountable positions essentially doubles the number of people who can shrug and say, "Not my department, mate." Lighter annual checks may save HR teams a spreadsheet headache, but they also make it easier for bad practices to bed in unnoticed. Precisely the complacency the rules were designed to tackle. The FCA wants snappier, product-specific alerts, and that's fine in principle. The red flag is motive. If warnings shrink to tweet length, the marketing copy around them can grow. Fewer, softer words make it easier for sales scripts to bury the hard truth that you can lose money beneath shiny graphics and promised returns. Remember, risk warnings aren't there for the people who already understand them. They're there for the newcomers that banks are about to phone under targeted support. If this ends in two-word disclaimers, could drop, well then what we've done is we've traded clarity for click-throughs. And while cash ISAs aren't earning much, they are simple. You know exactly how many pounds will be in there tomorrow. Capping cash at £5,000 forces the cautious saver to become an investor, whether they're ready to or not. And that's great for liquidity in equity markets, and brilliant for platforms that charge fees on funds under management, but risky for anyone who hasn't lived through a 30% drawdown. The Treasury says this will unlock growth. Fair enough, but growth for whom? It's small comfort to a retiree who's watching their nest egg yo-yo if they never wanted that roller coaster in the first place. Now, I'm a huge advocate for investment, but there are some people who just don't need to do it. Why take risk if you can achieve the desired result without it? Each of these tweaks look harmless in isolation. Faster forms here, friendly wording there, but taken together they tilt the playing field away from caution and towards risk, at precisely the moment consumer protections are being eroded. Some of the changes to the protections that consumers currently have are going to be shorter windows to make a complaint, even though historically mis-selling scandals have taken years to uncover, a weaker fair and reasonable test. The Financial Ombudsman Service will now be expected to check in with the FCA on how rules should be interpreted. This narrows its room to judge cases on a common sense basis when the rulebook is fuzzy. Smaller compensation checks. The standard 8% statutory interest on awards is being scrapped, so future redress will be paid at the bank rate plus 1%. At today's rates, that's roughly 6%, and that means a quarter less than before. Authorisations cut from 6 to 4 months. Senior manager approvals down to 2. Senior manager and certification regime streamlined by 50%. Let's remember why the current rules existed in the first place. Post 2008, we learned that if everyone is in charge, no one is. The senior managers and certification regime forced named executives to sign on the dotted line for misconduct. The result? PPI-style scandals plummeted, and UK banks paid more than $50 billion in redress without taxpayer bailouts. Speed is great for fintech innovation, but it's deadly for risk controls. Quicker onboarding equals less time for due diligence, stress testing, or culture checks. Banks have also just been given license to phone customers identified as cash heavy and offer what the Treasury calls targeted support. Personal nudges to shift idle cash into investment products. To many of us, that sounds less like impartial guidance and more like a ready-made sales script with your current account balance as the lead list. Cold calling retail customers about investments was curbed after the post-2008 mis-selling scandals. Suitability rules and retail distribution review pushed banks away from aggressive outreach because it often tipped into systemic mis-selling and a multi-billion-pound redress bill. Diluting those guardrails, especially while risk warnings are shrinking and fewer senior managers need to sign off, raises a familiar worry. Now, for balance, there is an upside if the policy is executed responsibly. A well-timed prompt from a trusted bank could help chronically under-earning cash savers beat inflation, build long-term wealth, and direct fresh capital to British businesses, starved of funding. But the key word here is responsibly. The last time we trusted the banks to act responsibly, well, we all know what happened. We've seen this movie before, folks, and the sequel usually has bigger explosions. Now, on day one of any economics A-level class, or even the first hour of any economics degree, you learn the iron law of supply and demand. The downward sloping demand curve, people wanting houses, intersects the upward sloping supply curve, built producing houses, at a sweet spot where price is P1 and quantity is Q1. Now, one could argue, and I don't think many of you would disagree, we already have a lack of housing supply and an excess in demand. We don't build enough houses. This means the price of houses rises to price P2, where quantity is Q2. Now, instead of the Chancellor tackling the supply side issue, raising the supply of houses to get us back to the optimal price, she's turned up the gas on the demand side. Everyone can borrow more and it's easier to access lending. Sounds great in principle, right? But in reality, if the same amount of houses are available, This increase in demand pushes the demand curve to the right. Translation? Prices climb rapidly, while the number of homes barely increases. Great for existing owners watching their equity balloon. Dangerous for new buyers, now saddled with larger debts, and for renters facing knock-on rent hikes. Now the Treasury argues that freeing credit incentivises builders. More mortgages equals more guaranteed buyers equals more housing starts. And if that happens, great. Maybe it leads to more houses suitable for first-time buyers being built and at a faster rate. But developers cite planning law and land supply, not consumer credit, as their main bottleneck. The other danger here is that relaxing who can borrow and offering guarantees to banks encourages lending to those who cannot afford it. And as anyone who remembers the 2008 financial crisis dubbed the credit crunch will tell you, that does not end well. From April 2026, long-term asset funds, essentially diversified private equity and infrastructure vehicles, can sit inside a stocks and shares ISA. That puts unlisted or thinly traded assets on the same retail shelf as FTSE 100 trackers. Add in Treasury talks of capping the amount of ISA cash a safe can hold, and you have a gentle but very real nudge from cash towards illiquid private markets. Cast your mind back to last year's pension fund reforms. Under the Mansion House agenda, large workplace pension schemes and local government pension schemes were encouraged and in fact expected to steer at least 10% of assets into the same kind of private market funds. The aim was to create mega funds with the firepower to back UK scale-ups and infrastructure. Together, these two moves form a clear policy arc. Channel the nation's long-term savings, both retail, ISAs, and institutional pensions, into private equity, venture capital, and real assets that traditional public markets don't finance as easily. Now you'll notice a growing trend with this video. There are some problems here too. Long-term asset funds allow redemptions only quarterly, or sometimes even less. Retail savers who think they can dip in and out may get a nasty surprise when markets wobble. And private assets are priced infrequently, and by appraisal, not by live market bids. That makes it easier for performance to look smoother than it really is, and harder for investors to spot trouble early. Private equity funds typically charge 2 and 20 style fees. That's 2% management charge and 20% performance fees, which can erode excess returns for both ISA holders and pension members. And without strong advice safeguards, less experienced ISA savers might chase headline returns without understanding the lockups, leverage, or downside scenarios. If hundreds of billions rush into finite UK private equity ecosystems, valuations could become inflated, squeeze future returns, and concentrate systemic risk in a less transparent corner of the market. Bottom line, funneling more of Britain's savings into private markets could spur economic growth and lift long-term returns, but only if transparency, fee discipline, and investor education keep pace. Otherwise, we risk transplanting the mis-selling dramas of the public markets into an even murkier arena. Morningstar reported that in the 10 years up to December 2020, investors underperformed the funds they were invested in by 1.7%, purely due to bad timing and panic selling. More first-time investors equals more timing errors. And if the bank's targeted support flops, complaints go to a slimmed-down ombudsman with a 10-year time bar. Convenient for the bank, but not for you. So investing newbies, if you've never invested before, don't be talked into it by someone in a call centre just because they're from your bank. Do extensive research, learn as much as you can about the process, the risks, the returns, the volatility, and the costs. And unless you can leave your money alone for at least 5 years, investing probably isn't the right solution for you. Prospective buyers, just because you can borrow 5.5 times your salary doesn't mean you should. Stress test your life. Kids, job change, rate spikes, will you still sleep at night? Make sure you really understand what that commitment will mean to the life that you will live after your purchase. Because the system's rigged against you from the start. The estate agent wants to see you buy the biggest house they can sell you, and the bank wants to lend you the biggest loan you can afford. But what's the point if that means all you can afford to do is eat, sleep, work, repeat? There is more to life than owning a big house. There's a world to see, hobbies to be enjoyed, families to raise, and loved ones to spend time with. Life is too short to stay on the hamster wheel just so the bank and estate agent can hit their quarterly targets. And for seasoned investors, evaluate your pension and ISA mix. Don't let shiny private market funds hijack sensible, low-cost core holdings. The Leeds Reforms promise growth, but history shouts caution. Deregulated banks and leveraged households equals crisis cocktail. Be sceptical, Be informed and above all, be proactive. Review your ISA, interrogate your mortgage plans and push your advisor for straight answers. Drop a comment below and let me know if you're bullish or bearish on these reforms. And hit the subscribe button to support our ever growing channel.